What are bad faith car insurance practices? Have you ever wondered what happens when an auto insurance company does not hold up its end of the bargain? Bad faith car insurance practices are the answer. These practices occur when an insurance company unfairly fails to meet its obligations to a policyholder during the claims process. It is important to understand that these actions go beyond simple mistakes or disagreements. They involve misconduct that violates the insurer's duty to act fairly and honestly. One common example of bad faith is unreasonable delays in processing a legitimate claim. While insurers need time to gather information, dragging out the process without a good reason can pressure policyholders. This pressure often leads them to accept lower settlements or even abandon their claims altogether. Another bad faith practice is the unwarranted denial of valid claims. This can happen when an insurer denies a claim without properly investigating it. Sometimes they misrepresent facts or wrongly cite policy exclusions. They may even ignore evidence that supports the policyholder's claim, which is simply not right. Lowball settlement offers are also a form of bad faith. Insurers might undervalue the damages or losses by using biased appraisals. This means they could offer less than what the policyholder truly deserves based on the actual damages. Incomplete or biased investigations can further complicate matters. If an insurer fails to thoroughly review all relevant evidence, they might make a decision that minimizes the payout. This is unfair to the policyholder who expects a fair assessment of their claim. Misrepresentation of policy terms is another tactic used by some insurers. This can involve not clearly disclosing limitations or using confusing language to avoid paying claims. It is essential for policyholders to understand their policy fully to avoid falling victim to these tactics. Bad faith practices are more serious than just a breach of contract. They involve unreasonable or unfair motives, which can lead to legal consequences for the insurer. Insurers have a duty of good faith and fair dealing. This means they must promptly and fairly investigate claims and pay legitimate benefits according to the policy terms. Recognizing bad faith practices is vital for car insurance dispute resolution. When policyholders suspect bad faith, they can use appraisal, mediation, or arbitration processes to resolve conflicts. These methods help ensure fair handling of claims and protect the rights of policyholders. In summary, bad faith car insurance practices include delaying claims, denying valid claims without cause, undervaluing settlements, and misrepresenting policy terms. Understanding these practices helps policyholders identify when their insurer may be acting improperly. This knowledge empowers them to seek appropriate dispute resolution and hold insurers accountable for their actions.